Let's talk about the security market segment. How the Indian security market has defined the way to get wealthy for the people. Now let's talk about the primary market and secondary market. How different types of investors can use the knowledge through primary and secondary market and can make wealth. We will learn about different types of instruments available in the market. Now let's first talk about the primary market. Now, where do the primary market stand? Now, primary market is the part of Indian financial market wherein if a company wants to raise money from the investors, it will launch its IPO, initial public offer. Through this, the company will raise capital from the investors, that is the common man. So, the primary market gives access to a wider and diverse investor base. The ability to raise capital at a low cost through transparent pricing mechanism like auctions and book building is the most important factor of primary market. Also, it enhances the investor confidence because of robust governance and disclosure requirements. There are liquidity and exit options available for the investors, enabling a recycling of capital. So if someone wants to stay in the market, they can continue. And if someone wants to exit from the market, they have the option as well. So a lot of flexibility is there in the market. That is the primary market. It also encourages entrepreneurs by providing funding and exit strategies. You will understand these benefits, which will help you to evaluate new issues and strategic impact on how you can make money for the long term. So what are different ways in which people or the companies raise capital from the primary market? The first is the public issue, which it is also called initial public offer, or FPO, which is follow-on public offer. Now, public issue, that is IPOs and FPOs, are broad investor base, wherein you will have to mandatorily list your company in the stock exchange. This is used to raise capital from the general public. The second type of primary market instrument is private placement, which is certain qualified institutional placements are popular route for listed companies. The listed companies can get faster access to capital by issuing shares to selected institutional investors. Then we have preferential issues. These shares are issued to selected investors within the listed companies. This is used strategically to strengthen partnership or bring in key stakeholders. We also have rights and bonus issues. The rights allow the existing shareholders to maintain ownership proportion. Bonus issue rewards shareholders by issuing free shares. Both rights and bonus protect and enhance the shareholders' value. Now, the way you select and come in the market depends upon your capital requirement, disclosure norms, and the kind of investor you are. Also, the cost, the investment type is important for which type of instrument you choose. For example, a common man can enter the market only through IPOs. However, if you're already into a company, you can do different types of, or you can enter through different types of routes such as private placement, preferential issues, and right and bonus issues. So these are some of the important factors which you should know about the primary market. Now let's talk about applying to an issue, which is to an already existing or to be launched IPO. So how does it start? What is the process? How do you actually list your company in the stock market? So you need to first choose a price range, which is the per share price, which is based on the market and company analysis. Then you record multiple bids at different prices, reflecting investor demand. Now you need to identify, the third step is to identify the price where demands equal supply, which will help you to set the final issue price. In the fourth step, you need to justify the price band. You will prepare a concise pitch using multiple company growth prospects and use of proceeds. So eventually, through this process, you'll be able to list your company in the stock market. This is where people will get the right to get into your company through your shares. So are different ways in which the market protects a common investor. Now, you will find that you have an offer document which is available on SEBI website, that is Security Exchange Board of India, before you bid. So you will have all the information about the company, the listing, what the company is asking for, what is the future prospect. You can use ASP or UPI payment to block funds until your units are allotted or confirmed. You will have to bid according to the minimum application value. If the bid is at cutoff price, you will have maximum chances of getting the allotment. If the shares are oversubscribed, the allotment is proportionately given to the people. And if someone is not getting the allotment, the funds will be refunded. There are certain checklists wherein every individual will be assigned a unique ISIN number, which will be an identity for all the transactions that will happen for the particular person or an investor. You can buy the dematerialized form of the lot through your Demat account. So this is how the entire process of the listing works. There are different ways in which different types of companies and institutions raise funds from the market. Now, if the government wants to raise funds from the market, it will come up with treasury bills. Now, treasury bills are for 91, 182, and 364 days. Through treasury bills, the government raises funds from the market. Also, the government can come up with government securities, which are called G6. And the state government can come up with STL, that is state development loans. Since it is backed by government, it is secure. Normally, they do not carry a very high rate of return, but a substantial rate of return you can get. The second is the PSUs and the private companies. The PSUs can raise the capital through disinvestment, through IPOs, bonds, which we have already learned. They can also use different routes like ordinary, preference, convertible, corporate bonds, and commercial paper. Also, the banks and NBFCs have the option to raise money from the market through listing of equity, coming up with bonds, commercial paper, certificate of deposit, securitization products, and mutual funds through NFOs. So this is how you actually make money in the primary market. Now, what does the secondary market do for you? It is important for you to understand the secondary market. Now, once the company is listed in the primary market, the shares of the company are sold in the secondary market. Now, this is a place which provides the liquidity to a common investor. If you want to continue, you can continue your association with the organization through your shares, or if you want to exit, you can easily sell your shares in the secondary market. So secondary market provides liquidity. It enables investors to enter and exit positions efficiently. There is a price discovery, which reflects the investor valuation and the sentiments of the market. So if you remain invested in the secondary market, as per the performance of the company, the share prices of the company might increase and decrease as well in the secondary market. The market prices act as a real-time economic barometer for broad economic trends. There are different market parameters such as Nifty and Sensex, which gives you a broader macroeconomic signals.